every financial advisor in the world will tell you to diversify, to hold a mix of stocks, bonds, real estate, and cash, to build a balanced portfolio calibrated to your risk tolerance and time horizon. What almost none of them will tell you is what that advice would have meant for someone living through the last 3 times a reserve currency collapsed. In each of the 3 best documented reserve currency transitions in modern history, the Dutch guilder decline, the British pound collapse in the 1970s dollar debasement, the British guilder decline, the British pound collapse in the 1970s dollar debasement that followed Nixon's gold window closure, the conventional, responsible, professionally endorsed portfolio absorbed catastrophic losses, not because the people holding it were foolish, but because the financial environment they had optimized for had ceased to exist. And in each case, the assets that actually preserved purchasing power across the transition were specific, identifiable, and in retrospect obvious if you knew the historical pattern. This video is that pattern, documented, specific. How long does it actually take? That is the question this entire series has been building toward. 6 videos examining the mechanisms of reserve currency decline, the bond markets, the gold, the oil, the middle class, the sanctions, the internal politics. 6 videos documenting the pattern, the precedents, the historical forces currently in motion, but none of them answered the question that matters most practically: how long does this take? Not in theory, not as a range of possibilities, an actual documented history measured in years with the specific milestones mapped and the timeline recorded. That is what this video does, and what history reveals when you actually sit down and measure it is both more reassuring and more alarming than most people expect. More reassuring because the timelines are longer than the crisis-focused financial media suggests. More alarming because in every single transition, the final acceleration, the phase where the transition moves from gradual erosion to visible, undeniable change, arrived faster than almost anyone predicted and came after years of apparent stability during which most observers had concluded the threat had passed. To understand why standard portfolio construction performs poorly during reserve currency transitions, you need to understand what standard portfolio construction is actually optimized for: modern portfolio theory. The framework underlying the vast majority of professional financial advice was developed in the 1950s and refined through the 1960s and 1950s. Its core insight is genuine and valuable. Combining assets with low or negative correlations reduces portfolio volatility without proportionally reducing expected returns. This negative correlation makes a blend of stocks and bonds a more efficient portfolio than either asset alone. The problem is that this negative correlation, the foundational assumption of balanced portfolio construction, is itself a product of a specific monetary environment: low and stable inflation, credible central bank policy, and sound government finances. In that environment, when economic activity slows, the central bank cuts interest rates, bond prices rise, and the negative correlation between stocks and bonds performs as expected. In a reserve currency transition, characterized by persistent high inflation, loss of central bank credibility, and deteriorating government finances, this correlation breaks down. Bonds perform poorly because inflation erodes their real returns, and because the creditworthiness of the government issuing them is in question. Stocks perform poorly in real terms because the earnings growth they generate is overwhelmed by the purchasing power loss in the currency they are denominated in. Cash performs worst of all because it earns no return while inflation destroys its value at pace. In this environment, the environment that characterized the late stages of every major reserve currency transition, the assets that preserve wealth are not the ones that perform well in the normal cycle. They are the ones that exist outside the monetary system experiencing the transition. This is the fundamental insight that the historical record of reserve currency transitions teaches about wealth preservation. Not diversification across asset classes within a monetary system, but diversification across monetary systems, holding assets whose value is not contingent on the continued function of the system under stress. The Dutch guilders decline from dominant reserve currency to regional currency between roughly 1720 and 1815 is the earliest transition for which sufficient financial records exist to reconstruct with reasonable confidence which asset classes performed well and which performed poorly. The reconstruction is necessarily incomplete. The financial data of the 18th century is far less granular than what exists for the 20th, but several patterns emerge clearly enough from the available records to be meaningful. Dutch government bonds, the most conservative, most widely held savings instrument among the Dutch middle and upper classes throughout the period of guilder dominance, performed poorly in real terms across the transition. The yields were nominally adequate, but the periodic devaluations and financial stresses of the transition period repeatedly eroded the real purchasing power of bond holdings. The people who held Dutch government bonds as their primary savings vehicle across the full arc of the transition preserved a significantly smaller share of their real wealth than those who held other asset classes. Amsterdam real estate. The primary alternative savings vehicle for wealthy Dutch citizens performed erratically during the early and middle phases of the transition. Amsterdam property retained significant value, reflecting the continued importance of the city as a commercial and financial center even as its global dominance waned. But in the later phases of the transition, as Amsterdam's relative commercial position declined and as the economic disruptions of the Napoleonic Wars affected Dutch property markets, real estate holders who had concentrated their wealth in domestic property absorbed substantial losses. The assets that preserved wealth most reliably across the Dutch transition were, by the historical record, two in particular. The first was foreign financial assets, investments in British commercial ventures, held by Dutch investors who had begun diversifying out of Dutch commercial ventures, held by Dutch investors diversifying out of Dutch domestic assets in the early 18th century. The Dutch merchant and financial class had by the 1740s and 1750s become strategic. These holdings preserved purchasing power across the transition precisely because they were denominated in the rising currency rather than the declining one. The Dutch investors who diversified geographically, who moved capital toward the ascendant financial system while still participating in the declining one, substantially outperformed those who maintained exclusively Dutch-denominated portfolios. The second was productive physical assets, Vogue and other trading companies shares that gave their holders claims on real commercial activity, rather than on financial promises. The Vogue's 17th century dominance was already fading by the early 18th century, and its shares ultimately lost most of their value as Dutch trade networks atrophied. These are ultimately lost, but the underlying pattern that claims on real productive activity tend to preserve value better than nominal financial claims during monetary transitions is confirmed by the Dutch experience, even though the specific vehicles of that period perform inconsistently. The British pound's decline from 1914 to 1976 is the best documented reserve currency transition in history, and the asset class performance data for this period is specific enough to draw direct practical lessons. The transition period encompasses several distinct subphases, each with different asset class dynamics, and it's worth examining them separately before drawing conclusions about the full arc. The interwar period, 1990, was characterized by deflation in the early 1920s, the brief gold standard restoration from 1925, and the Great Depression of the 1925s. In this environment, bonds actually performed relatively well in real terms during the deflation. British equities performed poorly during the Depression years. Gold, following the pound's departure from the gold standard in 1931 and the subsequent rise in the sterling price of gold, performed well for those who held it, though private gold ownership had been effectively discouraged by controls by that one-time period. 1959 saw emergency controls on capital movements, suppressed financial markets, and the effective subordination of all financial considerations to war financial considerations. War financial considerations to war financial. Asset class performance during this period is difficult to assess in conventional terms because market prices were distorted by controls. What the historical record does show is that physical assets, real property, productive land, durable goods, retained practical value in ways that financial claims did not, particularly as bombing and economic disruption created conditions in which physical possession mattered more than paper titles. The post-war austerity and Bretton Woods period, 1945-1967, is the most directly instructive subphase for understanding long-term wealth preservation through a managed reserve currency decline. During this period, British government bonds gilts performed poorly in real terms because inflation persistently ran above the nominal yields available on government debt. This is the financial repression dynamic documented in the middle-class wealth video of this series, the deliberate policy of keeping interest rates below inflation to gradually reduce the real burden of Britain's war debts. Gilt holders were being quietly taxed by negative real rates while nominal returns looked acceptable. British equities performed reasonably well in nominal terms during this period, but were subject to significant capital controls that limited their utility for wealth preservation across currency boundaries. The investors who preserved the most real wealth during the post-war sterling decline were: the historical record shows those who held three specific asset classes: the British investors who had managed to accumulate dollar-denominated holdings before the imposition of strict capital controls in 1947, and who maintained those holdings through the successive devaluations of the sterling era, saw their dollar assets appreciate dramatically in sterling terms with each devaluation. The 1949 devaluation, which reduced the pound's value from 443 to devaluation, which reduced the sterling value of any dollar asset by 44%. The 1967 devalue of any dollar asset by 44%. The 1967 devaluation, which reduced the pound further to 2 and 40-40. For British investors who had dollar exposure, each devaluation was a windfall. British homeowners who had taken on sterling-denominated mortgages, fixed-rate debt in the declining currency, found those mortgages progressively inflated away. The real burden of a 1945 mortgage was dramatically reduced by the inflation of the 1950s and 1960s. Meanwhile, the nominal value of the property itself rose with inflation. The combination of an inflating asset and a deflating real debt burden produced substantial real wealth gains for British homeowners over this period, precisely the mechanism described in the middle class wealth video as one of the primary channels of late cycle wealth transfer. The third was gold. Although private gold ownership was legally restricted for British citizens throughout much of the post-war period, those who held gold through legal offshore arrangements or who moved it into foreign custody preserved purchasing denominated assets. Every phase of the sterling declined with remarkable consistency. The sterling price of gold rose from 8.5 per ounce in 1945 to over 195 times of 170s, and 1975 to over 100% across the sterling decline, substantially outpacing the inflation that eroded other sterling-denominated assets. The 1970s dollar debasement following Nixon's gold window closure in 1971 is the most recent major reserve currency stress event and, for that reason, the most directly relevant to current investors, both because the data is most precise and because the conditions bear the closest structural resemblance to the present moment. The 1970s presented a specific asset class challenge that differed from the Dutch and British transitions in one important respect. The dollar did not fully lose its reserve currency status during this period. The petrodollar system, established in 1974, arrested the potential transition before Phase 4 was reached. This makes the 1970s more comparable to a severe Phase 3 stress, a contested transition that was ultimately stabilized by institutional innovation, than to a completed Phase 4 transfer. This distinction matters for interpreting the asset class data. The assets that performed best in the 1970s were those optimized for a high inflation, low growth dollar stress environment rather than for a full reserve currency transition. They may understate the degree of diversification that a completed transition would require. With that caveat clearly stated, the 1970s asset class performance data is striking in its specificity. Government bonds, the conventional safe haven, produced negative real returns across the decade. The combination of rising nominal yields as inflation expectations became embedded in market prices and persistent inflation above those yields meant that bondholders lost purchasing power year after year. A 10-year Treasury bond purchased in 1971 yielded approximately 6% annually, with inflation averaging over 7% across the decade. The real return was negative. The bondholders who had done the responsible thing, who had saved in government securities, as their parents' generation had been taught to do, absorbed systematic wealth destruction throughout the decade. US equities produced real returns close to zero across the full decade of the 1970s, with dramatic nominal volatility masking the inflation. The S&P 500 ended the decade at roughly the same real level it had entered it, having compounded inflation rather than outpacing it. Investors who held equities through the decade preserved nominal capital but gained nothing in real terms over the full period. Cash savings accounts, money market instruments, certificates of deposit produced the worst real returns of any mainstream asset class, with negative real yields throughout most of the decade as interest rates consistently lagged inflation until Volcker's 1980 shock. Now the assets that did work. Gold produced the most dramatic performance of any asset class across the 1970s by almost any measure. Starting at 35 per ounce in 1971, the official price at the moment Nixon closed the gold window. Gold rose to 805 timber per ounce at its January 1977 to 91. But across the first month of 1980, one times in 71, adjusted for the substantial inflation of the percent across 9 years. In real terms, adjusted for the substantial inflation of the period, the gain was approximately 700 to 800%. Oil and energy assets were the second best performing major asset class of the 1970s. The quadrupling of oil prices in 1973 and the further price surge in 1979 produced enormous gains for holders of energy assets, oil company stocks, energy royalties, oil-producing real estate. The energy sector was in effect a primary beneficiary of the monetary disorder that afflicted most other asset classes. Commodities broadly, agricultural land, metals, mineral rights, performed well in real terms throughout the decade. The inflation that destroyed the real value of financial assets simultaneously inflated the nominal prices of physical goods, making real asset owners the beneficiaries of the transfer of the beneficiary real estate with leverage, specifically residential and commercial property financed with fixed-rate mortgage debt, performed well for the same reason it had in the British post-war transition. The real burden of fixed nominal debt fell with inflation, while the nominal value of the property rose. This worked most reliably for properties with strong intrinsic economic utility, those that produced rental income, those in locations with genuine long-term demand, and less reliably for purely speculative property holdings. Foreign currency diversification. Holding assets denominated in the currencies that outperformed the dollar through the 1970s, particularly the Swiss franc, the Deutsche Mark, and the Japanese yen, also produced strong real returns for American investors with international exposure. Having examined the asset class performance across all three major transitions, the cross-transition pattern is clear enough to state with confidence. The assets that performed well across all three transitions share a single defining characteristic. They exist outside the paper promise system of the declining currency. Their value is not contingent on the creditworthiness of the declining sovereign, on the stability of the monetary system under stress, or on the confidence in paper claims that erodes during a transition. Gold worked in the Dutch transition through offshore holdings, worked in the British transition dramatically 1000+% gain in sterling terms from 1945 to 1976, worked in the 1970s transition 2300% nominal gain from 1971 to 1980. The cross-transition consistency of gold's performance during monetary stress is the most robust finding in the historical record of reserve currency transitions. Geographic diversification into the ascendant currency worked in the Dutch transition. Dutch investors in British assets outperformed. Worked in the British transition. British investors with dollar exposure outperformed dramatically. Worked in the 1970s transition. American investors with hard currency exposure, Swiss francs, Deutsche Marks, outperformed. The pattern is that moving capital toward the rising monetary system before that transition is obvious consistently produces strong real returns across the transition. Real assets with intrinsic economic utility. Productive land, energy assets, commodity producing businesses, residential real estate with genuine demand. These performed well in all three transitions because their value ultimately derives from real economic activity rather than monetary promises. They are imperfect hedges, subject to local regulations, to cyclical demand fluctuations, to political risk, but they share the defining characteristic of not being entirely dependent on the stability of the declining monetary system. The assets that perform poorly across all three transitions are equally consistent. Government bonds of the declining sovereign, cash denominated in the declining currency, and financial assets whose returns were entirely dependent on the continued stability of the declining monetary system. The historical record on asset class performance during reserve currency transitions contains a finding that is arguably more important than the asset class rankings themselves. Timing mattered enormously, and the optimal positioning window was typically much earlier than most people achieved it. In the British transition, the investors who realized the greatest preservation of wealth from dollar-denominated assets were those who had accumulated dollar holdings before the imposition of strict capital controls in 1947, before it was obvious to the general public that the sterling transition was entering its decisive phase. After 1947, the ability of British citizens to freely move capital into dollar assets was severely restricted. The door was effectively closed at precisely the moment when the greatest number of people were beginning to understand why they should walk through it. In the 1970s, the investors who captured the full gold performance were those who began accumulating positions when gold was trading between $35 and $10 per ounce in the early stages of the transition, when it was far from obvious that gold would appreciate to $850. By the time gold's performance was impossible to ignore. By 1979 and 1980, the move had already largely occurred. The investors who bought gold at $700 and $10 in 1979, responding to the performance they had witnessed, bought in at prices that the 1980 Volcker shock would rapidly destroy. This pattern, the optimal positioning window closing before the transition, becomes undeniable, and the rush of late entrants experiencing poor outcomes recurs in every transition. It reflects a fundamental feature of how transitions work. The mechanisms become visible before the consequences become obvious, and by the time the consequences are obvious, the positioning has already been made. The practical implication is uncomfortable but direct. The historical record suggests that the investor who waits for certainty before repositioning will, in every previous transition, have waited too long. And the investor who positions too early, who acts on pattern recognition before the pattern has fully expressed itself, risks both opportunity cost and the social discomfort of appearing to diverge from consensus. There is no historical resolution to this tension that produces a comfortable answer. The record simply shows that the people who preserved the most wealth in previous transitions were consistently those who acted on the pattern before it became consensus, and that the people who waited for consensus had substantially less room to maneuver by the time consensus arrived. This video has argued that the historical record of reserve currency transitions contains specific, actionable information about asset class performance. That argument deserves an honest acknowledgement of its limits. The first limit is uniqueness. The dollar's position in the global monetary system is in some ways genuinely different from previous reserve currencies. The depth of dollar-denominated financial markets, the global reach of American financial infrastructure, the sheer scale of dollar-denominated debt contracts that would need to be renegotiated in any transition is without precise historical precedent. The Dutch and British transitions occurred in a world with far less financial globalization, far less cross-border financial integration, and far less institutional complexity. An argument could be made that these features make the dollar more durable than previous reserve currencies, not less. The historical record cannot fully answer this argument. The second limit is path dependency. The asset class performance documented in previous transitions depended not just on which assets were held, but on specific institutional and regulatory conditions, capital controls, tax treatment, legal infrastructure that may not replicate in future transitions. The British investor who held dollar assets was protected from the worst effects of sterling devaluation in part because those assets were offshore and outside the reach of British financial controls. Future transitions may occur in a more heavily regulated financial environment, where similar strategies are less accessible. The third limit is the no transition scenario. The historical analysis in this video and in this series as a whole has been structured around the assumption that the current moment represents the early or middle stages of a reserve currency transition. That assumption is a probabilistic judgment based on historical pattern recognition, not a certainty. The United States managed its monetary position well enough in the early 1980s to arrest what had seemed like an accelerating transition, with Volcker's dramatic interest rate intervention restoring dollar credibility in ways that the historical pattern had not suggested was likely. A comparable institutional intervention in the current period, unlikely given the political and fiscal constraints, but not impossible, could produce a very different outcome from what the historical template implies. These limits do not invalidate the historical analysis. They frame it appropriately. The historical record is not a prediction engine, it is a pattern recognition tool. It tells you what has happened in comparable situations. It cannot tell you with certainty what will happen in this one. What it can tell you is what the people who navigated previous transitions most successfully understood that the people who navigated them least successfully did not, and that understanding, however imperfect its application to the present seems worth having. 8 videos, 8 mechanisms, 1 argument. The reserve currency clock is running. The bond markets are under stress. Central banks are accumulating gold. The petrodollar faces its first serious military challenge. The middle class is absorbing the wealth transfer that marked every late cycle phase. The dollar weapon has accelerated the dollarization. The internal politics of the dominant empire are fracturing, and the historical timeline places the current moment within the transition window that every previous reserve currency has faced. The historical record of asset class performance across those transitions is now in your hands, not as a prescription, as a map. The people who navigated previous transitions best were not necessarily the smartest or the wealthiest or the most connected. They were the ones who understood that the financial environment they had grown up in was historically specific, not permanent, and who had access to enough historical knowledge to recognize the pattern while it was still early enough to act on it. This channel exists to give you that knowledge, not because the future is predetermined, but because the map is the most valuable thing the past can give you. Subscribe because the series is not over. The next chapter goes deeper into the specific geographic and sectoral opportunities that the historical record identifies in the countries and asset classes that benefit from transitions rather than suffering through them.